go next level. So thank you so much. I would give it to Madhur to continue forward.
Thank you and welcome everyone. Can we go to the next page, please? So this is on our payments business. Our payments business has continued to scale up very nicely with improved profitability, like which I mentioned earlier. Our monthly transacting users, which is the number of customers who transact on Paytm app, has gone up 23% year on year and continues to see an upward trend. Our merchant subscription business, as we have mentioned before, which is a key focus area, that has more than doubled year on year. In the last quarter, we added 11 lakh merchant subscriptions. So this is a product and offering that continues to find larger and larger addressable market opportunity. All of this has contributed to our net payment margin improving 69% year on year to 648 crores. Just to remind everyone, our net payment margin is money that we make on payment processing, which is the revenue minus what we pay to the issuer banks, plus the subscription revenue. So going back to payment processing margin, we had given a range in December 2022 that this is currently in the 7 to 9 basis points, and including UPI incentives, this should including UPI incentive it is at 7 to 9 basis points. Currently, even without UPI incentives, which we did not record any of in this quarter, it is at the high end of our 7 to 9 basis points guidance. So we have seen encouraging trends here. That is as a result of increase in GMV of non-UPI instruments, such as EMI, which is a big focus area for us, both online and offline, as well as increasing share of our payment processing for card transactions. We are also experiencing lower interchange cost for wallet. As some of you know, there was an interoperability circular that had come out from NPCI, which is effective 1st April. So as a result, our interchange cost for wallet has gone down. Our interchange cost for, I apologize, just give me a second, please. Our interchange cost for Paytm Postpaid also continues to go down due to better portfolio quality, which is a theme that we had touched upon in the last quarter's earnings. Our subscription revenue is a direct result of the growth in merchant subscriptions, which, as I mentioned earlier, has gone from 38 lakhs a year ago to 79 lakhs in this last quarter. We go to the next page, please. Now a little bit about our loan distribution business. Our value of loans distributed through Paytm platform last quarter was just under 15,000 crores, which is a number that we had published in our monthly operating metrics. So this is a number that you already have. And this has seen significant growth across all three products. So Paytm Postpaid is up 138%, personal loan is up 202%, and merchant loan is up 232%. So we are seeing traction across all three of our products. As we have mentioned before, starting, I think May 22 is when we explicitly called this out, that our focus is on improving credit quality. One of the things that we are quite proud of is that the penetration levels are still very low, which means two things. One is that there's a huge addressable opportunity ahead of us, and also that we are very selective and when we work with our lending partners on who gets a loan on Paytm platform. Another indication of this is that the portfolio performance for our partners has continued to improve. Specifically in Paytm Postpaid last quarter, we lowered the range for expected credit loss with our partners. And this quarter, again, we are lowering the ECL rates range that we are giving. Earlier, it was 75 to 100 basis points. Now it is 65 to 85 basis points. So we are seeing consistent improvement in credit quality as a result of a number of business initiatives that we have taken. Go to the next page, please. Our commerce and cloud business, the co-branded credit cards and advertising have driven growth in the commerce and cloud business. It is up 22% year on year, which is lower than our overall business, but it is still a healthy 22%. In our commerce business, just to remind everyone, we sell travel, movies, and events tickets and deals and gift vouchers to customers. This GMV was 2,500 crores. It was up about 10% year on year. On a revenue basis, this was up about 12% year on year. The reason for the subdued growth was a decline in movie industry. So last June quarter, movie industry was seeing some healthy content. This June quarter has been lower than the previous June quarter. Also, there's been a decline in Play Store vouchers, which are sold that entire industry. And we also sell Play Store vouchers. So that entire industry has seen a degrowth. On a Q1Q basis, I just want to call out that Q3 and Q4 are strong quarters for our events business. So there is that seasonality in our business. Q1 and Q2 are much more subdued because of the lack of holidays, festive season, as well as weather. So our take rates have basically come down to what we had guided earlier, which is 5 to 6%, whereas in Q3 and Q4, we see a little bit of a higher take rate. On our cloud business, like I mentioned earlier, co-branded credit cards, they're continuing to scale very well. As you know, about a couple of quarters ago, we started to give numbers for activated cards. That number has now reached 7.5 lakhs, and our partnerships are doing very well. You may have noticed that we have launched a credit card with SBI, SBI RuPay credit card, PAYTM SBI RuPay credit card, which was launched about a month and a half ago. And we also saw growth in our advertising business. Can we go to the next page, please? And finally, some of the growth drivers in our business. Clearly, mobile payments in India still got very low penetration, particularly on the merchant side. We think that we are extraordinarily well placed in that business because the technology that we give to our merchants is very well accepted, and the adoption is growing very fast, particularly Soundbox and card machines. We are doing a number of other innovations in the payment ecosystem. UPI Lite, we were the first to launch the RuPay credit card on UPI, which you just mentioned, multi-bank and brand EMI aggregation. As I mentioned earlier, we are seeing uptick in that, and that is contributing to higher net take rates as well. And PAYTM UPI SDK for our online merchants. On the loan distribution side, we think that there's huge opportunity for growth, while we will continue to focus on ensuring superior credit quality for our partners. Further, there is good regulatory clarity on digital lending guidelines now in India. So that is also supporting the scale up of loan distribution business. Last quarter, we had mentioned that our target for this year is 3 to 4 new lending partners. On June 30th, we did announce the first of those lending partners, which is Shriram Capital. And I hope many of you have noticed that. PAYTM Money has launched a new bond trading platform. We think that there's huge underpenetration in India for retail investing in bonds. So that's a business which, while it is very early and very small right now, is a directional bet for us that we think that this is something that will play out over the next several years. So we are proud to be one of the early players in that. With that, I'll hand it back to the moderator for Q&A. As Vijay mentioned, we have put a detailed earnings release, and we have intentionally kept the presentation relatively short to allow as much time for Q&A as possible.
Thank you, Mr. Dora. With that, we'll start the Q&A session of the earnings call. As a reminder, if you seek to ask a question, kindly utilize the raise hand feature on your Zoom dashboard, and we'll seek the questions in the sequence of the raised hands and within the permitted time. With that, the first question of the session will be from Mr. Sachin Salgaonkar from Bank of America.
Hi, thank you for the opportunity. I have 3 questions. First question, is regarding your ticket size on loan. And clearly, Madhur, we could see, you guys lowering ECL range. But, while we're seeing that, we're also seeing, ticket size across every segment, which is PAYTM postpaid, personal loans, merchant loans is actually increasing, and perhaps in a meaningful manner. So just wanted to understand, how should we look at this?
Hi, Sachin. So Sachin, the reason for ticket size increase is that the renewal business is now maturing. We've been at this business, merchant loan postpaid for 3 years and PL for more than 2.5 years. Both in PL and merchant loan, more than 50% of our business is coming from existing users, and in postpaid, about 65% of business from existing users. So lenders have a much larger comfort in giving a higher ticket size to people when they're disbursing the second loan or a renewal of the existing loan to the users. The new user ticket size continues to be the similar amount that was happening, let's say, a year or 12 months back. But because the blended business has moved up, that's the reason ticket size has moved up.
So Bhavesh, directionally, it might inch up a bit more also, right, going ahead?
Yeah, so it may, but that's not a metric that we personally track. It is basis the comfort the lender derives and what is their underwriting policy. But broadly, our focus is that we should be, as the book matures on every product, there could be a stability point, both in merchant and personal in particular, that the existing customer renewal as a share of total business could inch up to maybe 60%. So yeah, you could expect marginal increase, but postpaid is a natural increase over a period of time. It will not see a dramatic increase because we still continue to be a consumption-led product, not a lifestyle product.
Got it. Second question, the new FLDG norms are out there. Just wanted to understand any change of thought in terms of how you guys are looking at the current business. And does that change incrementally something for you, i.e. in terms of getting a bit more partners or as well?
Yeah, so I think this is a very welcome move from the regulator. It just reinforces that the overall regulatory environment is very positive and pro building the digital lending infrastructure and credit business in this country. So we welcome this move with a lot of positivity. Having said that, our belief here is that risk management is a job of a regulated entity. They understand risk and the heterogeneity of models that they have built over a period of time much better than PAYTM would ever be. So our current model is not of taking risk, but helping the lenders to manage collections. We are committed to the model. We'll scale that business. Will it add and help in any new partners? Because we've never given FLDG, we don't have any inertia in getting new partners. Like you saw Shriram Capital or Shriram Finance addition, you would see many more large institutions getting added to our overall portfolio of partners that we work with without we offering any kind of FLDG. The short answer is that our model that we continue to pursue will continue as it is. We are not exploring any FLDG models with our partners.
Okay, and is Shriram already onboarded? Should we see contribution from next quarter onwards?
No, they're not. They're onboarded, but they're into technology integration. So our aim is currently that we're looking at sometime in Q3 that they should go live.
Got it. And the third question, sorry, one more question I have. Last question, on the software cloud data center expenses, clearly we did see them declining. And I presume this is because you guys have moved to a new platform. So just wanted to understand, going ahead directionally, this should continue to further come down as well, right?
Well, I think as a percentage metric of GMV, transaction revenue, etc., it should continue to come down. But you're right that we did see the benefit last quarter of effectively exiting our old platform, which I think I mentioned in the previous quarter's call that we were effectively running 2 cloud platforms in parallel. So exiting the old platform did give us a one-time benefit. You shouldn't expect it to sort of continue to decline in absolute term because as also the business scale grows, there are more transactions, more data, and so on, more compute required, more storage required, and so on. But as a percentage of revenue and so on, you should expect for this to go down over time.
Okay, thanks, guys.
Thank you, Sachin.
Thanks, Sachin. The next question will be from Mr. Nitin Agarwal from Motilal Oswal.
Yeah, hi. Thanks for the opportunity. A couple of questions. First is how many tie-ups are we looking to add now over FY24, 25 and to sustain this disbursement growth that we are reporting? And what is the outstanding loan book size with all the partners as on 1Q?
Hi, Nitin. So Nitin, I think last quarter also we had mentioned that this year we are looking to add about 3 to 4 more partners. One is already being announced and the remaining couple of partners we intend to announce over the next couple of quarters. That will help us to manage both the aspirations of the new partners who come in and the existing partners. And more importantly, is it will provide the much needed expansion of what those new partners bring to us. So this is something that we believe will happen. We could make some amendments as we go in the next couple of quarters in terms of adding more than what we are saying, but this is the minimum we'll add. With regards to your second question, if you could repeat that please once again for me.
Sorry, the outstanding loan book size?
So the loan book we actually don't track because our commercials are based on disbursements and not on the loan book. But broadly, what we understand, this is the average maturity of tenure and the composition. If you're disbursing, let's say 100 rupees, about 1/3 could be the AUM as a combination with all the partners. But this is more of an estimate. That's a range that you could take.
Okay. And of these 3-4 partners that you're looking to add, are we looking at banks also to come?
Yeah, you will see some announcements in banks also.
Okay. And the other question is like on the pending regulatory approvals, any thoughts or progress that we are looking over there for both the payment aggregator and the payment bank? And while we have mentioned that it is not affecting our business growth and overall aspirations, but as and when you get these approvals, how will things change in terms of the growth trajectory thereafter?
I think both are a different approvals which are pending. So let me talk about the payment aggregation business. I think the last update that we've given that there is approvals which are pending with the government ministries, etc. The process of engagement with them is already on. We'll file the application. That process is currently in the works, and whatever exchange of information has to happen is going on. And we remain hopeful that that process should end fairly shortly, and we should get the direction for further course of action in that area. Having said that, we've been explicitly guided by the regulator that we can continue to operate the business we were operating of online payment aggregation that we were doing. And as and when we were to get any kind of communication from the government of India, we shall keep them informed. So our business has not got affected, primarily for the reason that we've been in this business since a very long time. At least from 2017. So it's been about 6 years that we've been doing payment aggregation business. And being the leader in that business right from the beginning, we have had many customers who've been added in our system. And our focus has been to further deepen our relationship and penetration. And as you can see from both net payment margin and growth of GMV, that area of effort is really helping us. Yes, there is always an opportunity to add new clients. So we will welcome as and when we get the approval to be able to add new clients. It will have a marginal impact on a growth of our business, not a material impact, especially in the online space, because the online space, we believe currently, most of the large clients, we already are there. And the objective is to penetrate a lot more versus adding newer clients. On the bank side, that process is again on. As an associate of Paytm, the information we get from the bank is that the process of engagement with the regulator is on. Yes, it has taken a lot more time than we anticipated. But at this stage in time, we don't have necessary clarity as to when will the process be over. But we understand from the Paytm Payment Bank management that process is operating very comfortably and should get over soon. But we don't have any particular timeline to cross that.
Okay. And lastly, just to again come back on the loan side, we have achieved an annualized disbursement run rate of close to 60,000 rupees. And there has been a bit of concern in what we have seen after the regulator pointed out some discomfort on the growth in unsecured loans. So have you seen any change in behavior or underwriting with your partners? And how sustainably can this value of loans, because we are already 60,000 crore a year, how sustainably do you see this growing over the next 2-3 years?
I think the focus of ours right from the beginning has been to ensure that we are able to originate the best quality portfolio to our partners, and that approach of ours hasn't changed over the last 3 years. Yes, we have been reading in the press about the discomfort, which is particularly called out for banks, etc., by the regulator. Our partners thus far haven't come across stating anything of a discomfort of portfolio that we've originated with them. So you see even a personal loan product on Q1, we have grown. While we ourselves believe that we should calibrate growth as we move forward, but we don't see the growth getting tapered off to a level wherein somebody showing discomfort. Our belief is that there is an opportunity of the business, if calibrated to the macro conditions of both of risk and reward ratio, whatever growth is then hence as an outcome desired, we will pursue that. You will see us being a lot more conservative in growing, because our objective, just like we have demonstrated in in postpaid, we would love to demonstrate the same in merchant loan and personal loans also, that we can continue to grow at a healthy pace and also have a portfolio perform better than what we did last year. With that plan in mind, our focus will remain to get better portfolio and also a decent level of growth, but it will be calibrated looking at the macro.
Thanks, Bhavesh. Thanks a lot and wish you all the best.
Thank you, Nathan.
Thank you.
Thanks, Nitin. The next question will be from Mr. Rahul Jain from Dolat Capital.
Yeah, hi. Thanks for the opportunity. As you mentioned in your this presentation that there is an increase in GMV from card and EMI, which has helped in better payment margin. Just wanted to understand that do you see any possibility that we have just yet touched the QR-based payment through the debit side of the economy, but the next wave could be QR-based payment on the credit side through EMI, card, BNPL or whatever. And incrementally, regulator also keep on talking about the under penetration on credit and all that. So you think that could actually change the dimension in a different way, and this 7 to 9 BIP that we keep talking about could stay at a higher level, and overall revenue per GMV basis could also expand materially?
Rahul, thank you for this, and I'll ask Bhavesh to add post what I suggest here. Number one, that you actually pointed out correctly that there is a incredible attention, there is a extra attention that is being put by regulator and every other payment provider player like banks or NBFCs to make credit on counter available at more and more number of times and more possibilities there, whether it is led by credit card. So the credit card acceptance on UPI, QR, and then you can see the growth in the credit card spends. You can see the growth on BNPL equivalent, whatever whether it is a large ticket or small ticket on the counter is the growth direction. While the debit side has plateaued is not what I would say. There is a large amount of customer base still pending to come on board, but definitely credit is adding the flair of extra revenue and it will add the net bips margin continuously extra. We don't know how many people will actually have a credit access and then in turn pay on counter using credit, but that is definitely going to be there. And Rahul, it is not just on debit, it is also on prepaid. So prepaid and credit are the flares that could add extra margin to payments in India. That is what I'd say. Over to Bhavesh for...
Yeah, no, I think I'll just supplement to what Vijay said with one simple statement. As the affluence and the aspiration of larger masses of India is growing, affordability of those aspirations or driving affordability becomes a very important element as far as retail is concerned. And we are clearly seeing trends which were not necessarily as available last year, be it online or offline. A lot many more brands, just not mobile phone brands, but even lifestyle brands and travel brands, etc., are seeking affordability. So it's a technology that PAYTM is able to power on the ground, be it on online space or offline space or even QR space, of being able to drive affordability. And that market has really helped margins improve. And as Vijay rightly said, we will see, irrespective of what is happening on the acquiring side of technology, be it QR or card machines or online gateway, affordability will become a very important driver for increasing payment margins and actually having the customer get the right deal with the merchants on a long period of time. So that shift, as India becomes more affluent and more aspirational, that shift is a 3 to 5 year shift. It will move a lot more to affordability and higher.
Hello.
Yeah, Rahul, that is what answer is. You can continue the question if you have.
Yeah, sure. Just one more question. Looking at this annual spend on your marketing expense, Q1 was 1.8. There was some saving that we were expecting from non-renewal of some sports sponsorship contracts. So how one should look at for the year and for the future on this marketing expense side?
There is no doubt about it. There was IPL, etc., as you noticed, if you would have seen those things. So those are their kind of expenses that we had. But at the same point of time, instead of being a more rupee value reduction, we look at it as a percentage of revenue direction, because there is a tremendous amount of opportunity of acquiring consumers. We will be diligent and bothered about good quality customers. So Rahul, if you notice, Q on Q, our user growth has not been the dramatically large than previously, and it is not because that incremental users have not come. Actually, incremental user has been growing. We've been pruning and adding features which are related to safety security on our platform. So we will continue to focus on consumer as a business also, Rahul. And that is why I would say, even though you would have seen in a trend basis, it is more, but I think as a percentage of revenue, we would keep it at a particular level.
Sure, understand. Just sorry if I could squeeze in one more, which is related to this headcount addition that we see, which I guess is largely for the onboarding of merchant. Can you just explain why we need such a large pool? Is it because of new markets, new micro market, and new geography that we keep going? Because if I see if there's an absolute addition of 1 million on a run rate basis, then ideally the same set of people with some servicing requirement, but it should not grow very linearly, because the people who would have already deployed may not be as busy, with the existing base.
Yeah.
So when we see that non-linearity in that.
Yeah, totally agree. And in fact, the interesting thing here is that we are expanding to new geographies. That is why there is a cycle of person getting onboarded, getting trained, and getting full, let's say, productive in number of deployments. But we also see requirement of adding even more number of people, because mobile payment and the opportunity of merchant accepting payment is dramatically growing to next level of geography level where we have reached today. I mean, I also want to share that we used to one point of time, like many times we have had in these analyst call also discussion, that what is the TAM for number of devices or subscription you can sell. And we continue to see that number actually growing once we reach that milestone where we see that what new kind of customer would come. So newer devices, newer markets, and newer merchant needs served by devices is the way forward for us. And in these, training those number of people and deploying those number of people is something that we continue to do. And we will keep adding. Like I told you, in consumer and merchant, both sides, there is an extraordinary opportunity for next 2 years.
I just maybe add a small point to that, which is, I think we had mentioned this last quarter, but over the last couple of quarters, we have really focused on enhancing the service as well. So there's a service team which does a fantastic job of making sure that the merchants are getting really high quality experience. So that has been an aspect of some of the growth, but predominant aspect is, as Vijay mentioned, which is we see opportunities to go deeper in the country. And we are seeing an increase now in the net adds, and it's not very noticeable yet. We're doing about 10 lakhs a quarter. Last quarter we did about 11 lakhs. So we are seeing that opportunity to grow a little bit faster.
Appreciate it, Nicola. Thank you so much.
Thank you, Rahul.
Thanks, sir. The next question will be from Mr. Rahul Bangadi from Lucky Investments.
Yeah, thank you for taking my question, sir, and congratulations on a continuously improving set of numbers. Two things here: the revenue from financial services and others, as a percentage to the loan dispersed, seems to be trending downwards, and it has now reached about 3.5%. Could you help us with how we should kind of look at this take rates here, or the commission here?
Yeah. Hi, Rahul. So the last quarter we had mentioned that because of better portfolio economics on postpaid, the interchange that we pay, which used to get added to the revenue of the lender, and some part of it used to come back to us as gross income, because we've reduced the interchange by almost 50 basis points last quarter. You saw an optically a number of take rate go down in Q4, right? This quarter, the idea that we have been able to understand more strategically with our lending partners is that with the repo rates kind of plateauing, we did not want it to pass on the increase of repo, which happened in the last quarter or maybe a quarter or two, to the consumers, because we wanted to make sure that we are able to maintain better portfolio quality and just ensure that our portfolio mix is more high quality than maybe of users who were on the edge and they were comfortable given the last year macro, but may not be comfortable given this year macro. So we've taken up broadly a 0.1% upfront hit in our take rate on credit predominantly, which we believe that we will recover similar or more through the collection incentive as portfolio performs much better because the portfolio mix is better. On a trend line basis, we don't see this number go down. I think this number is the stable number that we can very comfortably see because the repo is not changing. Hopefully it is not changing unless it changes for a long period of time. One will have to reverse a statement. But at this point in time, we believe if repo remains where it is and our portfolio mix is now, I would say largely optimum, the take rate should remain what it is today or maybe start to inch forward in Q3 and Q4. So clear assumption should be is that you could take between 3.5 to 375 on a stable base cases.
This 3.5 to 375 obviously also includes the incentives that you would be getting on collecting what you would have disbursed, let's say 6 months back or 1 year back, right?
Yeah, it includes incentives that we collect almost 15 months back because merchant loan and personal loan is where the large part of incentives come in because this is where we have a larger part of incentives and collections. So yeah, about 15 months back.
Okay. And the other question was on this soundbox thing, the revenue from the subscription of merchant devices, would that still be of the order of $100 a month, or you have given a broad range in the presentation? What would be the average number that we can go by?
So net of GST, it is slightly more than 100 rupees a month.
But that's about it because you've given 100 to 500 range in the presentation. So that's why.
So the sound box is slightly more than 100. So you can take 100 slightly conservatively.
Okay.
And we have the card machines, which depending on the model can be 300 to 500 rupees. But that is a much smaller percentage of the base. The sound box is the much larger percentage of the base.
Oh, okay. So 100 is a good number to go by net of GST.
Conservatively, 100 is a good number to go by for the overall base.
Thank you very much. Thank you for answering this question.
Thank you, Rahul.
Thank you, Rahul. The next question will be from Mr. Piran Engineer from CLSA.
Yeah, hi. Thanks for taking my question and congrats on the quarter. So a couple of questions here. One is just a follow-up on one of the previous participants' question. Like, really, what happens to all the employees after 3 to 5 years? Because you, I think, almost tripled your employee count in the last 3 years or so since the IPO, or maybe 2.5 years. And once you achieve your penetration of sound boxes in the next 2 years, at the rate at which you're going, you'll reach 1.5 crore sound boxes in another 2 years. So really, what really happens to all these employees?
So Piran, we first of all, thank you for noticing that we have never stopped investing in our future growth and opportunity, and it is an important thing as continued business we see, and we don't see it as a expenditure that is, let's say this is one-off. We believe that there is a great opportunity to build a large technology distribution, and obviously payment is one part of the technology. Then extending it to commerce is the next part of technology that we are working upon. And then later we could find out some other service and technology that we could give them. So we look at it as a distribution channel and moat for India's small micro entrepreneurs and companies. And we believe that we will have different use cases at different stages of time. So as a direction, while we are continuously adding, we will optimize it at a particular point of time when we see that there is not that depth of penetration coming in, or per person productivity is not that much. But right now there is all the reason to add even further. And secondly, like you said, what will we do is we in mature markets, let's say in a large metro market, we have started to sell deals business, if you've started to notice that, which is enabling more commerce. So there will always be hopefully something else. And if we don't find something which is palatable and useful for commercial revenue generation, we would happily optimize the number of people. But right now, for next 2-3 years, we see it continuously growing.
So you should think, Vijay, can you, if I could just add one point. So you should see, for example, the device subscriptions as the revenue stream and the technology which this distribution team is supporting today. We think the base case is that there will be new distribution, new products and new technologies and new revenue streams that could be distributed to these merchants. So that's sort of the base case. That's what we are sort of planning towards. I couldn't tell you what will be the killer product 3 or 5 years from now. I could give you a few ideas, but I couldn't tell you what the killer product will be, but that's where sort of our innovation comes in.
Okay. And just getting back to Vijay's point, can you give an example of, like you said, in metro cities, you started, engaging in different ways to improve commerce. So can you just give an example of, what that could be?
A gift voucher is a simple example. We are selling gift vouchers of different and enabling it for more number of people.
So this will be even for your mom and pop, like Kirana stores?
They may do a deal. They may do a deal more than gift vouchers. So there will always be some things.
So if you go to deals, and there's a section on PAYTM app for deals and cashback. Within that, if you go to, there's an icon for deals. And then you can see restaurant deals, you can see retail deals. So restaurants will run deals and gift vouchers, retail stores will run gift vouchers. So that's something that is available on the PAYTM app. And that has scaled up tremendously on the supply side recently.
And that's because of your feet on street, or is it more a B2B part? Like, I think you would tie up with, say, Domino's and say, okay, why don't you?
No, you should see there are standalone restaurants there, individual single restaurants. Then national restaurants are obviously there. We look at them as enterprise. And enterprise coverage is, like you can see, is driven by a particular size of the team. But this is definitely a individual store kind of thing.
Got it. Just secondly, in terms of online merchants, that we do payment aggregation for, just wanted to understand. So one is that you get growth because, let's say, your online merchant is growing. Let's say Flipkart is growing, 30-40% year on year. And Sath you also get that growth. Is there something we can do ourselves to, say, gain market share, among all the payment aggregators that they tie up with? And if so, what is it? Is it more pricing led, or do we offer more products? How does that space really work is, what I want to understand.
Yeah, there are two line items, two key drivers of getting more share of wallet of current customer. Number one is, like you very well said, give more number of payment options. And number two is give better success rates. The pricing is now not a big factor. Incidentally, surprisingly, pricing is actually not a factor, because losing a customer for them is costlier than getting a few bips saved on a pricing. So contrarian to the pricing value as a pricing, it is more led by better success rate, more payment instruments.
Got it. And just lastly, pertinent question for now, any thoughts on Jio? I know it's a pretty broad-ended question. They could disrupt the merchant lending part of it with their JioMart business is what I'm really alluding to.
I think there is a large market out there to be served by many more number of large players. And we believe that this country's opportunity is so underserved that we believe that in India, many more big, from distribution to the book ownership to the large institute, every kind of space has opportunity for many large players. So we believe that there will be opportunity for everyone to coexist and expand on opportunity. And I think everybody would address it from their strength point of view. So there will be always an opportunity for everybody to win. And there is no, surprisingly, the best part I can tell you in this business is there is no winner take all, and there is no winning of someone means less for someone. So there is lot more number of people, many more number of people needed in the industry and to serve the small customers of this country.
Got it. Okay, that's all from my end. Thank you and all the best.
Thank you, Piran.
Thank you, Piran.
Thanks, Piran. Next in queue is Mr. Samir VC from JM Financial.
Yeah, hi. Thanks for the opportunity and congrats on a good set of numbers. One is on the indirect cost line, still growing 40%. Some thoughts there would be helpful. Should I go ahead or we take that first?
Sorry, I'm not sure. No, you feel free to finish all your questions and we'll just
secondly, on the number of merchant loans during the quarter that stays flat QOQ, is it purely seasonality?
Did you want to finish?
But you could complete the question, and Bhavesh is here. You'll take
and finally on Vijay's comments with respect to, one is employees kind of sales staff on the field kind of spread geographically. Can you indicate what kind of number of towns or cities would they be spread across? And finally on potential use cases, say 3 to 5 years down the line, or revenue streams down the line? Any examples would be useful if you can highlight that. That's all from my side.
Yeah.
Bhavesh.
Yeah, let me take the non-internet cross question, and Madhur can step into that. See, from a purely merchant lending Q1Q piece that you mentioned, I want to repeat, we're not chasing a metric which is number of merchants taking credit or value. Our metric is always that we're able to service the demand out there with the best interest of the portfolio for lending partners. Having said that, as the book is maturing, we're getting a lot more business, which is very high credit quality of existing merchants taking more versus the newer merchants coming on the play. Q1 generally is that period of time when newer merchants are less interested to credit because they really plan the business, and Q2 and Q3 onwards, we see a much higher demand, and we will see the newer merchants taking more loan, and hence total number of merchants taking loan will increase. But our focus is always to make sure that we're able to retain our existing merchants and merchant loans and obviously ensure we're giving them more, both from a portfolio construct and retention and quality of book. To your location piece, to question of Vijay, yeah, we currently are close to 500 locations, depending upon what product you're dealing with. Our idea here is that if you were to come back last year in the same quarter, we would have been closer to 400. So we kind of added about 100 locations over the last 12 months. Our thinking here is that QR is the first destination product, paper QR, and then Soundbox follows, and then card machines. So we are obviously delivering QR in much higher number of locations because we also do DIY QR, etc., and Soundbox will follow. So that will be the demand that we foresee over the next 2 to 3 years, really on the devices side to keep growing, and hence our sales force will keep growing. Madhur, you want to take the question?
Yeah, on the other indirect expenses, there's sort of no one straight explanation to it. There's a number of, this is the other within the indirect. So it captures a number of our sort of smaller expenses. And unfortunately, that number is a little bit lumpy. I do expect this number to come down over the next couple of quarters. And
okay,
then,
and finally on the use case opportunities over, say, 3-4 years.
Yeah, so I don't think we want to get too far ahead and get into sort of speculative zone, but I think the best example that you can think of is that 7 or 8 years ago, when we first launched QR code in India, QR code was the technology. And now, 4 years ago, we started to make devices the technology. And like Vijay mentioned, we are now seeing an additional opportunity in deals and gift voucher solutions. We've also mentioned in the presentation that we sell loyalty software to our merchants. So those are the things that we're working on. They're not as big in terms of number of merchants or number of subscriptions as QR code is or as devices is, but they'll always be, we are big believers that merchants, when they have more technology, and especially if we are able to connect them to our customers, because we have a huge customer base as well, on our app, will benefit in many ways. They will benefit on payment side for sure, but they'll also benefit on basically being able to grow their business, which is what we call commerce in cloud. So we will discover new things, just like we've discovered deals and gift vouchers is something that we're going to hopefully scale going forward.
Fair enough. And if I can just squeeze in one more, could you give some quantification of what has been the gain on the interoperability circular norms with respect to payment margin?
Yeah, so Sumit, the circular came in only in April. There is a bit of tech protocols which the network wants both acquirers and issuers to achieve. So that all the market participants, including PAYTM Payments Bank, who issues wallet, is currently in the dev state and certification. So I guess actual benefit can start to accrue end of Q3 and Q4. It's too early to say, but there will be benefit. But actual benefit can be seen only in Q3, Q4.
Okay, so still more upside likely.
I won't use the word upside because I think the way I would say this piece is it just increases the acceptability of PAYTM Payment Bank wallet, and hence gives more reasons for users who use PAYTM Payment Bank wallet, and that wallet product has been growing in spite of growth in UPI. The wallet product has been growing. It will have further reasons for users to use wallet because its interoperability will now be across QR codes and payment gateways. So I think more than revenue and the net payment margin impact to it, I guess that there will be much more benefit of further penetration and use case enhancement for wallet, which will eventually in the long tail result in some benefits also.
Fair enough. This is useful. Thank you and all the best.
Thank you.
Thank you, Samir. We have Manish Shukla from Axis Capital with the next question.
Good morning and thank you for the opportunity. First question, as you look to add more lending partners, do you see you trying to do more type of products or just these 3 products you think are good enough?
Yeah, so Manish, I think it's a good question. Our focus is that there is a fair amount of penetration which is still left, if I would use the word, on the Paytm platform and otherwise industry to further do what we can do in these 3 lines of product. And our current focus is to work with our partners to leverage their understanding of risk in various geographies and their technology capability to build scale. So we're not looking at adding new product, but there could be some variants, if I may use the word, of customizing a personal loan or a postpaid or a merchant loan. But if your question is, will we start doing, let's say, mortgages or loan against property? The answer is no. So there will be variants of these products because we still feel we're in early growth stage of building scaling this business.
Sure. And as it pertains to lending, in the past, you have mentioned the 2x2 constraints, that is not more than 2-year tenor, not more than 2 lakh ticket size. You see that limit, those restrictions getting, let's say, you're increasing those limits going forward?
Yeah, so we're not increasing limits. I think there is a life cycle of a credit customer. What we have seen is that is a sweet spot where we're able to get the best return for risk versus reward, both win-win for lenders and for ourselves. The more higher you go, there is rate negotiation when the risk is much lower. So the margin on the table reduces. So our focus has been where we can make the best risk reward ratio. Currently it's 2x2. If we do believe in future, there's an opportunity to have a balanced risk reward ratio for, let's say, as an example, I'm not giving you a guidance, but I'm making a simple statement, 3x3. Yeah, we would look into it with our partners. But at this point in time, our focus is to build majority of book under 2x2.
Okay. Sticking to loans, looking at the ECL data, just curious, the ECL on PL and merchant loan is almost similar, whereas merchant loan is a daily debit product and PL is a purely unsecured product. So why should the ECL in the two should be same?
Yeah, so I'm not sure. This is a risk. This is a portfolio performance question. I'm not sure it has anything to do with that tenure. But the PL as a product is largely hinged on users who are looking at as a cash in the bank, where the merchant is actually leveraging their payment inflow that they're getting on a Paytm QR or a Soundbox. It just happens to be that both ECLs are largely pivoting to a similar number, but the return on both products are very different. You know, the personal loan business is operating at 16, 18, 20% IRR, whereas the merchant loan product is operating maybe a couple of percentage point higher. So the return on a merchant loan product, both for lender and us, is higher, while with the same ECL, and PL marginally is lower than merchant loan. It is just a coincidence that both of them are trending similarly. It's not by design.
Okay. And really the last question, the new Paytm SBI RuPay card, are the revenue metrics for these materially different than the other cards that you originate?
No, so with SBI, the commercials are similar. It's the product has a much better acceptance. So if you were to say that if there are 100 people looking for a credit card of Paytm SBI, and now with that 100 increase to 200, yeah, it could increase to 150, because this product offers the customer the choice to link it on a UPI handle on Paytm app and be able to use it across QR codes of Paytm and other QR codes. So acceptance is the moat of this product, not the commercial. So we will be in a position to expand the market together with SBI of more users wanting to move into a RuPay credit card and link them on a Paytm app and use it across QRs. So hence, in terms of value of total gain that we will get, at the cumulative level will be much positive, but the per unit economics is largely similar.
Sure. Thanks, Bhavesh. Those are my questions.
Thanks, Manish.
Thank you, Manish. We'll take given the scheduled time of the session, we'll take 3 more questions. For any questions we cannot address in this session, we request you to please write into ir@paytm.com and we'll be addressing those questions. The next question from the session will be from Mr. Vijit Jain from Citi. Vijay, the line is unmuted.
I think Vijay got dropped off. We can move one.
Now we come back to him.
Yeah. The next question will be from Mr. Sumit is also dropped off. The next question will. Next question is from Mr. Rahil Shah. Rahil, your line unmuted.
Hello, hi. Good afternoon, sir. I just have one question. Directionally, how do you see, when do you see like expecting PBT to break even, excluding ESOP cost? So just your views on it.
So we're not giving sort of forecast, I think.
Yeah, no, I'm not, no, definitely not expecting that. Just your, from your perspective. So directionally from the business point of view, how do you see it improving from here on? So just a tentative.
No, so again, that would be guidance, which I don't think is appropriate to give on a call like this. But I think if you're seeing our EBITDA trajectory, and we have, if you look at our December presentation, we have mentioned what the growth drivers of our business are. We've also given indications for where we see some of the costs going forward. So for example, we have said that cost of building the platform should be growing at about 15 to 20%, and so on. And from a and we've also given indications of when does ESOP cost start to reduce, which is around second quarter of 2024, or sorry, second quarter of FY25. So when all of those things sort of come together, then there should be a rapid translation of EBITDA to net income. And that's sort of broadly how those numbers work. Rahil, are you still there?
Hello. Hello.
Yeah, Rahil, are you still there? Please go ahead.
No, that was it from me. Am I audible? Yes.
Yes.
Okay, thank you.
Thank you, Rahil. The next question will take us from Mr. Jigar Walia from Home Group. Jigar, you can unmute your line.
Hi, thanks for the opportunity. Sorry, my connection was bad. If this question was already answered, I'm sorry, but I just wanted to understand a couple of things on devices and on the net payment margins. On the devices side, are you having better success in terms of moving people up to higher value devices? Or are you also having better success in kind of getting most of your device footprint to actually pay up a subscription fee? I'm just wondering if the revenue increase that you've seen on a QoQ basis in payments is driven more by devices, or is more of a payment instrument type of phenomenon?
So, sorry, go ahead.
Go ahead, Madhur.
So if you look at the net payment margin, and if I could just answer it that way, I think we provided commentary that the payment processing margin has also improved significantly. And the reasons for that is, one is we are seeing a lot of increase in EMI and cards, where we make substantial net payment margin. Obviously, we're seeing increase in UPI and wallet and all of those things as well. But more recently, we have seen an acceleration in EMI and cards. So that is one factor. The second factor, like we mentioned, is on the cost side, with the interchange cost for both wallet and postpaid, for slightly different reasons, but we have sort of described that in the earnings release. The growth of subscriptions is a factor in the revenue, but it is not the predominant factor. And maybe to answer your question, and to perhaps clarify, all the merchants who take devices from us pay us a subscription. So they are all on a subscription plan. We may, in a very, very small percentage of cases, run certain offers and so on. But merchants who take devices actually pay us a subscription fee. So you can pretty much assume that all of the 79 lakh merchants who are using our devices or have a subscription from us are on the subscription plan, which generates revenue for us. Did that sort of answer your question, Jigar?
Actually, that was Vijit's question. Jigar is yet to ask. Jigar, please go ahead.
Sorry.
Yes.
I got confused. I apologize. Vijit has dropped off again, so we will maybe talk to him offline. Jigar, please go ahead.
Hi, thanks. Okay, first question is on this average take rate as a trend is kind of been trending down, and this time it was kind of a bit of a sharing on the repo rate hike. Incrementally, should the present rate should be a steady rate, or you should look at it as the trend kind of continuing for some bit while more before it stabilizes?
So, Jigar, I just had mentioned to a similar question previously. I think this is more calibration to not passing on the increase of the last repo rate to the user and kind of absorbing between ourselves and the lending partner. So there's a small blip of about 0.1% hit in take rate, but it will be more than compensated, maybe in a long arc of 12 to 15 months on collection incentive. Your portfolio will be better off because you are choosing much better customers at a marginally okay rate. Having said that, we believe this is the kind of the bottom of the take rate because there is no more further repo rate increase which is expected to happen. If that is the reality, then you can assume this is broadly the range at which we are operating. This from here on in a couple of quarters we will start to see this move on.
Fair. Got it. Other is on the M2U increase. No, this quarter has been less. I mean, we've been increasing by 5 every quarter. This time it's been 2, but of course, the focus is more on the penetration, and the sound boxes and devices have been doing fairly better. So incrementally, should this be the run rate that would look at that? No, instead of adding 5, maybe 2 to 3 could be the run rate going ahead, and incrementally there should be more sound boxes, and accordingly probably one can factor slightly more on the depreciation or the cost as far as devices are concerned.
I think the two answers are a bit different. Our strategy on user and strategy on merchant are different strategies and obviously not kind of competing with each other. So let me first answer the merchant part to you. The merchant part, we remain very confident both that the infrastructure that we created of adding more sales force and the product upgradation that we've been able to make. You could see in this quarter, we were adding about 1 million devices a quarter. Now we're adding about 11 lakh, 1.1 million. Our belief here is maybe on a quarter to quarter basis, this number will be 11 lakhs or marginally more. So device trajectory will be decently on an upward gain, and we remain confident for not just this year but even next couple of years that this penetration will keep increasing. On the user side, we have had a very clear-cut focus to continuously increase user experience, both in terms of how our app is used by the users to make payments and also the security features. We've been very acceleratively working on giving newer app versions to our users over the last maybe 3 to 4 months. And we took a bit of a clear call in Q1 of this year, just to beginning with this, that we would like all our users to be using our latest app version, which has better UI, better features, better product experience and speed, and better security, etc., etc. That resulted in maybe a couple of million users who did not upgrade to the latest app version, not transacting on the app. Now, this is, we know, a temporary issue. We don't see any negative trend on new user addition or retention of our existing users. This is more of a product upgrade that we would like all our users to use. And hence, in this quarter, we've seen marginally a couple of million users getting lesser. I don't think this is a trend to multiply over the next few quarters. We believe we should continue to grow the way we're growing last year over the next couple of quarters.
Perfect. One more is on the payment processing. So clearly payment processing charges have gone down and payment income has up this, and because of the mix EMI and cards and non-UPI instruments. So if you can share what is the mix overall for us right now, and are you seeing it as a kind of a trend, or it's again kind of a blip and it should again go back in favor of UPI immediately or short? But is there something wherein you can see this increase in non-UPI and EMI and cards picking up well? Actually, is there anything?
There's no dip, Jigar. There's no dip in UPI. It's that other instruments have grown up because we have deployed more devices. So more devices mean that we can acquire more card payments and credit-related payments. But UPI has blipped is not the fact.
Understood. Understood.
The UPI continues to grow well on our platform. But what we're seeing is that other instruments are also now growing at a higher rate than they were previously, especially because of the success that we are having on card payments and EMI payments, both online and offline.
Understood. Depreciation lastly should continue at a slightly higher rate, given the traction is a little better.
So the depreciation, we do depreciate the devices quite conservatively. So for example, the soundbox is depreciated over 2 years, even though the life of that device is, we think, is longer. So we should see this depreciation last quarter as a bit of a base. And as we expand the platform, or we expand the merchant base rather, then we should see that continuing to inch up.
Sure. Thank you. Thanks.
Thank you.
Thank you, Jigar. The next question we'll take is from Mr. Saurabh Kumar from JP Morgan.
Hi, team. So just 2 questions. One is, what's the contribution of the distribution business in the overall financial services pool, and how's that been trending? And the second is, on this unsecured lending. So if there is additional price competition in the market because all the banks and NBFCs are going here, who absorbs the, the ROA hit? Will there be a chance that Paytm again kind of takes some part of that? Or do you think that you have ability to pass this on to the lending partner? These are 2 ones. Thank you.
Yeah. Hi, Saurabh. So let me take the second question first and then come to the first question. See, there is, as I said previously also, there is a balance of risk and reward. Our belief it is that a good business is built where both partners are making money, which is Paytm as an LSP and lending partner as a regular entity. The consumer has to love the product, and hence sticking on to the narrative of 2x2 and sticking on the narrative of giving a best product experience gets you the upside. Having said that, I want to be very clear in my assessment that if this is the end of repo increase, I don't think anybody has to suffer with regards to any compression of revenue that they are making. If for whatever reason we will see in the future repo was to go up again, right, then we'll have to calibrate to how much to be passed on, how much to be retained, etc., because this is the peak of the repo in my opinion. Beyond this, if you really pass on to users higher interest costs, you may see deterioration of portfolio, which is not the focus here, right? So we don't see any margin compression happening on the current state. If the repo was to start come down, which maybe let's say in Q3 or Q4, we will only see margin increase of portfolio mix and marginal increase in our revenues coming out of that entire thing. On the first piece, if you could repeat the question, it'd be great, because then I can contextualize the answer to that.
Okay. So Bhavesh, just on the second piece, my question was, irrespective of the repo, let's say, some of the banks start reducing PL rates because, we have seen repo rates increase, but PL has not gone up. So my question was essentially, due to competition, if it comes down, what happens? And the first one was, what is the contribution of the non-lending, the distribution business, your stockbroking, other piece in the overall insurance distribution in the overall financial services revenue, and how's that been trending?
Bhavesh, if you allow me, I'll take the first question quickly, and then you can please explain the impact of repo rates and competition and so on. So Saurabh, in our financial services and others revenue, roughly, depending on the quarter, roughly 85% is related to the loan distribution and collection business. I should point out, and we have a large explainer on this in the earnings release, that the MDR that we earn on postpaid does not go in to the financial services and others in the payments business. And all of the credit card, co-branded credit card business that we do with HDFC and SBI and others goes into the cloud part, right? So you're looking at 85% of that financial services and other revenue being related to loan distribution and the collection for those three products, excluding the postpaid MDR.
And it'll be growing at the similar lines as financial services or slower or?
Currently, it is growing at now roughly the same pace. Over the last couple of years, the share of loan distribution and collection has grown, which might be obvious from the fact that that business has scaled up from being really very small 3 years ago to being one of the largest revenue drivers for PAYTM.
And so to your point again, with competition increasing, we haven't seen actually, to be very honest, competition increase in less than 2 years and a 2 lakh ticket size business, because a large part of the banks are actually focused on more higher ticket and longer tenure. There, the competition is a much higher competition. And currently we're not in that space of offering higher ticket and longer tenure. So in this space is more to do with what is the right risk reward. I again repeat that you could actually pass on and try to earn a much larger revenue share for yourself or with a partner, but maybe originate not the best credit quality in the system. So this is less of a competition issue, but more of a portfolio mix issue. And hence we don't see that there is a challenge on the revenue that we earn or a partner runs in this cohort. Yes, in a larger cohort, there could be some competition, some challenge.
Okay, thank you.
Thanks.
Thank you, Saurabh. And now for the last question of the session, we'll take it from Mr. Anand Bhavani.
Thank you for the opportunity. 2 questions. One is of the 3.5 to 3.75% that we get for loan distribution collection, how should we think of the split between the 2 activities? And the second question is on the same lines. For our collections, in a scenario whereby, let's say, the lender judges collections to be deficient, are there any penalties which can exceed the 3.75% that we earn combined on loan distribution and collections?
Anand, we've always maintained that point of view that we don't offer any kind of guarantees. The lender is free to decide whom they want to underwrite, what is the loss that they want to assume in the commercialization of this model, and whatever is the upfront they intend to pay us and what they want to pay us as a collection incentive. If let's say an example, the lender had a 5% expectation of loss and the loss was to be 6%, that 1% belongs to them. If the loss was 4%, the 1% belongs to PAYTM because we are spending the effort and the cost to be able to collect on that account. So we don't have any kind of liability, explicit or implicit, to be able to get anything in our system with the portfolio performing worse off than what they anticipated. So I'm just mindful of repeating this piece. And now that with FLDG, etc., coming into play, obviously there will be many more lenders who will take FLDG, etc., from different partners and would like to deal with that model differently. But our model remains, what we've been able to communicate here in our system.
And how should we think of the split between, let's say, distribution and collection services?
Yeah, so different products have a different math. Postpaid has lesser distribution. I would say there is MDR, there is convenience fee, etc. But I'll give a simple answer. As an aggregate, you could see about 0.5 to about 0.75% of current disbursement coming as collection incentive and the rest coming as distribution.
Noted. Thank you, and all the best for coming quarters.
Thank you, Anand. I think we are way over time, but I am conscious that there are probably more questions and we have run out of time. So please, I request everyone who still has questions to feel free to write to ir@paytm.com, and one of us will come back to you over the next few days, and in any event, speak to you over the next week. I'll hand it back to the moderator.
Thank you, Mr. Dora. With that, we come to an end of this earnings call. Thank you for joining us for your questions. And as Mr. Dora said, please do write into ir@paytm.com for your pending questions. Thank you.
Thank you, everyone.
Thank you very much.
Bye.